Guys, warm welcome to another Week 8 video. This week's video will cover the trading week running from Monday the 2nd to Friday the 6th of August 2021. And it's going to be a very important week for the Aussie dollar, with the RBA policy decision setting up to be a very interesting one given recent developments. Now, from the middle of the first quarter of this year, the Aussie dollar has been trending lower ever so slightly against the vast majority of its major peers, with only the Japanese yen really weaker than the Aussie dollar at this stage. Now, the lack in upside was partly driven by the RBA's persistently dovish stance compared to the likes of the RBNZ and the BOC and the BOE, and some of it was also a little bit of froth that needed to be unwound, and some was also attributed to some dollar strength. Now, throughout this time, we've held a weak bullish bias for the Aussie dollar, given a couple of factors. Firstly, the continued positive risk appetite in the medium term for risk assets, for pro-cyclical assets, the better than expected economic data that we've been seeing out of Australia, the better than expected economic recovery post the pandemic, as well as that commodity boom in prices that we've seen surging to the upside, obviously favoring Australia's terms of trade quite a lot. Now, recent developments have actually this week made us change our fundamental outlook for the Aussie dollar from weak bullish to neutral, given the heightened uncertainty on a couple of different fronts. Now, the current virus situation is a big complication for the Australian economy, as well as, expected policy normalization from the Reserve Bank of Australia. Australia has been much slower, of course, in their vaccination drive compared to countries like the UK and the US. And unfortunately, the Delta variant has really been taking its toll. That massive rise in virus cases have prompted the reinstatement of some pretty strict lockdown rules. And despite hopes of easing those measures, this week actually saw 4-week extensions to lockdowns in places like New South Wales. Now, we also had reports today on Friday stating that military personnel have now been deployed in certain parts of Australia to help reinforce those lockdown rules. And as a result of these recent lockdowns, we've seen a couple of different market participants now actually forecasting a contraction for Q3 growth, and some also pushing back as a result of that their rate hike expectations from 2022 to 2023. Now, it's important to realize that the government has pledged some support to help alleviate some of the economic pressure, and even though a full recovery is eventually expected, this short-term hiccup does really complicate matters for the RBA. Now, anticipation that the RBA could walk back their recent reduction or plans to reduce asset purchases in September further exacerbates that growing policy divergence between the likes of the RBA and the BOC and the RBNZ, which is expected to see the Aussie dollar underperform its high beta pro-cyclical counterparts like the Kiwi dollar and like the Canadian dollar due to these hiccups, or until these hiccups is resolved. Now, seasonality, as we can see on the screen, is another negative factor. In the last 20 years, August has been the worst performing month for the Aussie dollar, with an average performance of negative 0.95% for the month, and seeing losing months 70% of the time. Now, we don't look at this data and say, okay, because the vast majority of August we see downside, we just sell the Aussie dollar. We need different reasons for why we would like to sell the Aussie dollar. And what we're seeing here is that from a seasonality point of view, there could also be some additional downside playing out for the Aussie dollar. Now, the reason why we see this type of seasonal blip to the downside has less to do with the Australian economy right now and more to do with the Aussie's high beta characteristics, because what we normally see happen is during the Northern Hemisphere summer months in August, when that kicks in, traders basically swap their desks for the beach. And we usually see a considerable drop in liquidity and volumes during the month of August. And more often than not, this type of environment translates into higher levels of market volatility, which of course sparks or could potentially spark some risk off flows, which is negative for high beta currencies like the Australian dollar. So again, it's not due to the economic outlook that we've seen August perform so bad for the Aussie dollar. It's more due to that seasonality factor in terms of thinner liquidity, lower volumes equals normally higher volatility. Now, the other interesting driver this week was iron ore futures that suffered some punchy moves lower on both Thursday and Friday. TSI iron ore futures contracts were down more than 13% at the time of doing this video. The push lower was mostly attributed to China announcing some sizable increases in tariffs for steel products. There was a little bit of a delayed reaction on Thursday, because we saw the announcement coming out, and only a few hours later we saw that big flush to the downside. Now, the reason why the tariffs had such a big impact is it comes from China's drive right now to try and lower emissions. And for them to really lower emissions, they basically need to cut back on production. So if you cut back on production, it means there's less demand, obviously bad for prices. Now, the reason why this is so important for Australia can be seen here on the left-hand side. This is an extract from the OEC website with data updated until 2019, showing that iron ore is the biggest export for Australia at almost 24% of exports, and over 80% of that goes to China alone. So the fears of slower production and slower demand from China is not only bad for iron ore prices, but also bad for the Australian economy, and should be bad for the Aussie dollar as well. Now, the other factor to watch apart from just iron ore, also on the China front, is those current fears right now about a potential bigger than expected slowdown in the Chinese economy, because we had the PBOC a couple of weeks ago actually announcing a 0.5% triple R cut, and that has raised some speculation from market participants as to why they thought it was necessary to do that, sparking some fears that there might be a bigger than expected slowdown coming up for the Chinese economy. And because the vast majority of Australian exports goes to China, that's obviously very important for the Aussie dollar as well. Now, despite all of these drivers, the reaction in the Aussie dollar this week was fairly muted, surprisingly resilient despite all of these factors. Even though the Aussie dollar did move lower, it wasn't nearly enough what we would have normally anticipated by looking at all of these various different factors. So it's definitely a currency that we are keeping a very close eye on going into the week ahead. Now, our attention for this week for the Aussie will turn to that RBA meeting, where markets really right now wants to find out how the recent developments in both China as well as the virus situation in Australia, how that has impacted the bank's assessment of the economy and how it could potentially affect their monetary policy. Now, recall that during the previous meeting, the RBA announced that they are planning to scale down their weekly asset purchases to 4 billion from 5 billion. That was from September, or planned from September. Now, they were planning to buy at that lower pace of 4 from September running into November, and then at the November meeting, they were planning to basically decide what the future of that quantitative easing program will be. Now, with the recent virus situation and of course question marks right now emerging about China, there are quite a few participants who think that the RBA will, at this week's meeting, announce a delay of those plans to taper purchases in September. And there's actually some participants like Westpac who expects the bank to announce an immediate increase in asset purchases to 6 billion per week from the current 5 at this upcoming meeting. So that will certainly provide markets, if we do see something like that happening, it will certainly provide markets with a very clear signal about the bank's resolve to keep policy accommodative for as long as needed to allow the economy to recover and rebound. Now, the one caveat to keep in mind about that, if we do see a potential surprise increase in the weekly purchases, normally an increase in asset purchases is expected to be negative for the currency. Now, there is the odd chance that the markets could interpret such a move by the bank as a more positive thing, basically providing more accommodative policy and stimulus for the economy to try and curb the negative fallout from the virus, and that could potentially foster an even stronger rebound when the virus eventually calms down, and that could actually be seen as a positive for the Aussie dollar. So that, of course, it's not the baseline expectation from such an event. It's not the baseline expectation from what we would usually expect the market to do, but it's always just good to think about the way that the markets might interpret such a surprise in the way that it reacts to these types of surprise announcements. So that's definitely a key caveat that we're watching. Now, in terms of potential dovish and hawkish outcomes, a more dovish meeting, if we see the bank announce that those tapering plans for September will no longer take place, that is, of course, expected to be negative. Right now, there's not a lot of certainty. It's not a consensus view for the markets right now, which means that if they do announce it, we could still expect some downside in the Aussie dollar. If they come out and announce that QE purchases will increase to 6 billion from the current 5 immediately, that will, see that negative move to the downside. Just keep that caveat in mind. Just explained, the markets might actually see that as a positive if it means that there could be a potential faster recovery once the virus situation calms down. So just do keep that in mind. And then thirdly, if they explain that the virus situation has now pushed back their normalization expectations, where they thought that they weren't going to be raising rates until 2024 at the earliest, if they say that that is now being pushed back or potentially pushed back, that will also be seen as more negative. From a potential hawkish point of view, if they announce that despite everything going on with the virus, they actually still do plan to go ahead with that tapering in September, that'll be seen as a real big positive for the Aussie dollar. If they say that the current accommodation they have is still very much appropriate despite the virus escalation happening, that's also will be seen as more of a positive and a hawkish tilt from the bank. And if they explain that the virus situation hasn't really changed their normalization plans, that should also be seen as more positive from the bank despite the more bleak virus situation. Now, in the case of a dovish outcome, because we have a bullish bias for the Kiwi dollar, and the RBNZ is expected to hike rates next month, we do like downside in Aussie Kiwi in the event of a dovish outcome. And because we have a bearish bias on the Japanese yen, if it is a hawkish outcome, we like an Aussie yen upside bias in the case of a hawkish surprise from the bank. So guys, that's everything from our side. Do remember that, you know, these potential outcomes and the potential market reactions is merely a guide for what we would expect to happen in the event of these various outcomes playing out. And the markets can always surprise in the way that it reacts, as we explained with that caveat for a potential increase in QE. So, you know, these examples is never intended to be trade calls. It's rather intended as a framework for you to use in your own scenario planning. All right, guys, that's everything from our side. Hope you guys have a fantastic week and good luck trading that RBA event.